Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about American Homes 4 Rent quarterly report. American Homes 4 Rent, AMH, is a real estate investment trust that specializes in developing, renovating, leasing, and managing single-family homes as rental properties. The company's primary function is to act as the general partner of its operating partnership, which owns substantially all of its assets. The company provides various services and businesses, including property management. AMH has a dedicated team of 1598 personnel who handle property management, development, marketing, leasing, financial, and administrative functions. Single-family home rentals. AMH offers rental properties to households in select submarkets of metropolitan statistical areas, MSAs, within 24 states. Development. Through its internal AMH development program, the company develops thousands of built-for-rental homes per year to meet growing demands. Joint ventures. AMH partners with other companies to develop and manage properties through unconsolidated joint ventures. In addition, AMH provides various services to support its business operations, including leasing. The company offers leasing services for its rental properties. Marketing. AMH has a marketing team that promotes its properties and services. Financial management. The company's financial team handles accounting, budgeting, and other financial functions. Overall, American Homes 4 Rent is a comprehensive real estate investment trust that provides a range of services and businesses to support its single-family home rental operations. American Homes 4 Rent maintains a market capitalization of $11 billion, broadly in line with the industry peer group. American Homes 4 Rent trades at a higher price-to-earnings ratio of 26 times and a lower price-to-book ratio of 1.66 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 42% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.89%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of the key factors that have impacted the company's financial performance. Revenue growth is primarily driven by an increase in rental properties, with revenues rising from $1,156 million in 2025 to $1,234 million in 2026. This growth is attributed to a 2.7% increase in rents and other single-family property revenues, as well as a 3% average monthly realized rent per property increase. Additionally, the company has seen an increase in net proceeds received from sales of single-family properties and other, as well as proceeds received from storm-related insurance claims. On the other hand, revenue decline is primarily driven by losses on early extinguishment of debt, gains on sale and impairment of single-family properties and other, net. Reduced acquisitions of single-family properties through broker sales via the MLS and National Builder Program, increased time and costs associated with land development and construction process for rental homes, decreased availability of bulk portfolio acquisition opportunities, and competition for target assets and available capital. These factors have contributed to a decline in revenue growth and have had a negative impact on the company's financial performance. Overall, the company's revenue growth is driven by an increase in rental properties, while revenue decline is driven by various factors including losses on early extinguishment of debt, reduced acquisitions, increased costs associated with land development and construction process, decreased availability of bulk portfolio acquisition opportunities, and competition for target assets and available capital. The company's net income experienced a significant increase of 15.7% from $128,713 to $148,844 between 2025 and 2026. This growth can be attributed to various factors affecting the company's profit margins. One notable change is the decrease in gain on sale and impairment of single-family properties and other net. In 2026, this figure dropped by $16,428 from $62,016 in 2025 to -$78,444. On the other hand, depreciation and amortization saw an increase of $2,416 from $124,928 in 2025 to $127,344 in 2026. The impact of these changes on profit margins is evident. The company's profit margin rose by 3.6% from 28% in 2025 to 31.6% in 2026. This increase can be attributed to the decrease in gain on sale and impairment, which had a more significant effect than the slight rise in depreciation and amortization. The company's financial performance indicates a significant milestone. According to the provided information, the company has successfully generated positive operating cash flow. This achievement signifies that the business is capable of producing more cash than it consumes in its daily operations. A review of the company's financial statements reveals that this positive trend is consistent with industry standards and expectations. The ability to generate operating cash flow is a crucial indicator of a company's financial health, as it demonstrates the organization's capacity to meet its short-term obligations and invest in future growth initiatives. The confirmation of positive operating cash flow on page 48 further reinforces this conclusion. This detailed analysis provides assurance that the company's financial management strategies are effective in generating sufficient cash to support ongoing operations and strategic investments. The company's debt level and interest expenses have shown some fluctuations over time, but overall, they do not indicate any significant changes. In terms of debt level, there is a discrepancy in the reported figures. On one hand, page 24 shows an increase from $5,095,735 to $5,127,926, while on the other hand, page 2 reports a decrease from $5,532,614 to $5,575,044. However, it's worth noting that page 33 mentions that the company borrowed an additional $30 million and paid down $80 million under its revolving credit facility, which could explain the discrepancy. Regarding interest expenses, there is a clear indication of an increase from 2025 to 2026, ranging from 6% to 6.2%. This suggests that the company's interest expenses have risen over time, but the overall impact on the company's financials remains unclear without further context. Management is optimistic about the company's outlook, citing strong demand for single-family rental homes and attractive acquisition prices. They expect to continue generating cash flows from operations to fund business needs. The strategy focuses on developing and acquiring single-family homes as rental properties in a geographically diversified portfolio. The company has a robust pipeline of sales, with $129.9 million in single-family properties currently in escrow. Management's growth strategy involves developing built-for-rental homes through their internal program and acquiring newly constructed homes from third-party developers. They aim to maintain and grow revenues by retaining tenants, increasing rental rates, and investing in a proprietary property management platform. To achieve this, the company will prioritize growth through ongoing capital investments into existing properties, focusing on increasing average monthly realized rent per property and fees from single-family properties. Management expects to satisfy cash requirements through various sources, including cash on hand, operations, and borrowing capacity under their revolving credit facility. However, they acknowledge potential risks from new laws and regulations restricting institutional ownership of single-family homes. The company has made several significant transactions in the recent period. In terms of acquisitions, the company borrowed $30 million on its revolving credit facility within 3 months ended March 31, 2026. Additionally, the company incurred acquisition costs for business combinations during this time. In contrast, the company has also engaged in divestitures. Notably, the company recorded a gain on sale and impairment of single-family properties and other assets. Furthermore, the company repurchased and retired 3.2 million Class A common shares in April 2026. These transactions demonstrate the company's strategic efforts to manage its financial position and operations. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently distributed significant amounts to its investors. For instance, in Cone 2026, it paid out $141.4 million, while in Cone 2025, this figure was $131.2 million. In addition to paying dividends, the company has also been actively buying back shares from the market. Specifically, it repurchased and retired a substantial 8 million shares, demonstrating its commitment to returning value to shareholders through share buybacks. Concerns about inventory buildup and supply chain disruption have been raised. Inventory buildup is evident with 594 homes identified for sale, which may be offset by 457 newly constructed homes delivered. However, there are also 1,037 properties held for sale as of March 31, 2026. The supply chain disruption concern is more specific, related to the National Builder Program. This program relies on rental homes acquired from third-party developers, which in turn depend on the inventory of newly constructed and under-construction homes. That concludes the financial summary for American Homes 4 Rent. Feel free to comment below, and I will be happy to answer them when possible.